Hello, Seth Peterson here. We're talking about step 7 of the buying process, which is the appraisal and the financing. Now, if you have a cash offer, you probably are going to skip this step altogether. There's definitely no financing, and you probably don't have the appraisal contingency, although it is possible to include that in a cash offer. So first, let's talk about that appraisal. An appraisal is hiring an appraiser to give their opinion of value. They're going to look at comparable sales in the area and market data and come up with an appraisal report, which will have an appraisal value. And that's their opinion of what this house is worth in today's market. So the appraisal contingency is saying that if the appraisal value is lower than the purchase price, then the buyer can choose to terminate the offer. So that's the right that they get. That's the protection they have, is that they can just walk away from the deal if the appraisal value is too low. Now, what happens in practice, if the appraisal value is low, there probably is going to be a negotiation where the buyer and seller are trying to salvage that deal. Maybe they reduce it to the appraisal value, maybe they split the difference, maybe the buyer is like, that's fine, I'm still going to go ahead and purchase the property. So that's what happens, but the protection the buyer has is they can terminate the offer if the appraisal value is too low. Now, it's connected to the financing because when you have a financing contingency, your lender requires that you do an appraisal. So you most of the time you're also going to have that appraisal contingency. And then what if you do go ahead with the purchase and the appraisal is lower than the purchase price? What happens is the lender is only going to give the loan up to the appraisal value. So whatever that difference is, the buyer is going to have to make that up. So if the appraisal value is $5,000 lower than the purchase price, then when it comes time to closing, the buyer is going to have to bring their down payment and the closing costs plus an extra $5,000 to make up that difference. So it could be a significant thing for the buyer to move forward with an offer with a low appraisal. But depending on the situation, they may or may not be okay with that. But that's why most buyers want that contingency, to give them the right to walk away, because a lot of buyers don't have the extra $5,000 or whatever it might end up being. So that's pretty much the appraisal contingency. The financing contingency side of it is basically the saying that it's contingent on them getting a loan from a lender, and the end of that process is getting a loan commitment letter from the lender, which is going to be basically them saying, you're approved, everything looks great, you're approved, with a couple of conditions. Usually there's a couple of minor conditions. Maybe they need to verify your employment again, like the day before closing, or maybe there's a small repair that they want to see done with the property. If the appraisal hadn't been done yet, it would be contingent on that. So it may have some conditions on it, but for the most part, it's saying that we've looked at everything, it's gone through underwriting, and you're approved to get this loan. So if you were denied financing, you would get a denial letter saying, we've looked at this stuff, and due to XYZ, we cannot give you a loan. And then they would give you that letter. So as long as you give them the denial letter within your financing contingency time frame, then that would be another out of the deal. That's the protection the buyer has for that financing contingency, is if they get denied within the time frame, they can walk away from the deal. So, but ideally you get approved and you get that loan commitment letter, and then you submit it to the seller appropriately. So those are the basics of the financing and the appraisal contingencies, and next time we'll be talking about title, so we'll see you then.